15% to global growth in the current year. Financial markets remain volatile as uncertainty over future monetary policy path is keeping market sentiments on the edge. New Zealand has earlier today increased its rates by 25 basis points. Food and energy insecurity and risks of debt distress pose downside risks to outlook for emerging market and developing economies, that is EMDEs. According to IMF, 39 low-income developing countries are in debt distress or at the risk of debt distress. On the upside, global growth is being supported by the easing of supply chain disruptions, gradual normalization of energy and food markets, easing commodity prices, and reopening of the Chinese economy. Global inflationary pressures are also showing signs of abatement, although they remain well above the target in most of the countries. Central banks across the world have continued to tighten monetary policy, though at a much slower pace relative to the aggressive 75 basis points rate hikes which we witnessed in 2022, while some central banks have even taken a pause in their recent meetings. We have a case of Canada which took a pause and then again went for an increase. So therefore, global monetary policy is still settling down because the inflationary conditions are fast evolving. And all central banks are watching it with what I call an Arjuna's eye or what others call a hawk's eye. As central banks raise interest rates rapidly to contain inflation, fault lines emerged in banks and non-bank financial intermediaries. The resilience of the global financial system has been severely tested in the recent times, following the banking sector turmoil in the United States and in Switzerland. Naturally, it resulted in financial stability concerns, not only in those countries, but all around. Quite naturally, the outlook has been adversely impacted, particularly in the advanced economies. The proximate cause of this banking turmoil in the United States and Switzerland in March 2023 is a confluence of rising interest rates, unrealized losses in debt securities portfolio, and other idiosyncratic risks. Coexistence of high inflation and banking stress is complicating the responses of central banks as they face a trade-off between the risk of either straining financial markets or having to tolerate longer periods of high inflation. Amidst these global uncertainties, the Indian banking system remains stable and resilient with strong capital and liquidity positions, improving asset quality, better provisioning coverage, and improved profitability. Let me now turn to the domestic growth scenario. Sanjeev has already touched upon it, as I said. For the current year, for the year that has just ended, that is 22-23, the estimates are that it will be 7%. But there is a possibility that it could be even more. The data will come at the end of this month. According to all the recent trends, it will not be a surprise if the GDP growth of last year comes slightly above 7%. But let's stick to 7% for the time being. And the trends, the fourth quarter trends in particular, it initially appeared in the third quarter that there was a pent-up demand which was supporting economic activity. But all the economic indicators in the Q4 of last financial year, they saw that economic activity sustained momentum, and in fact, all the high-frequency indicators, about 70 of them which we monitor in the Reserve Bank of India, almost in all of these high-frequency indicators, the momentum was maintained in Q4. So therefore, I will not be surprised, we should not be surprised if the growth is slightly more than 7%. For 23-24, we have given a figure of 6.5%. And we have said that, with lot of, we have done our internal analysis. Of course, the IMF and other international institutions have given lower projections. For instance, the IMF projects it at 5.9%. But we derive confidence at this point of time from the fact that agriculture has done well, and we are assuming a normal monsoon. Services sector continues to perform very well. In fact, as you all know, although merchandise exports slowed down, moderated last year and have moderated, it is the services exports which have really gained further momentum. So agriculture has done well. Services sector on the whole is doing well. The capex and the infra spending by the government has also picked up with, again, large provisions in the budget for capital expenditure by the government. There is evidence of revival of private investment also. We notice it in certain sectors, particularly steel and cement. Your members of CII will know better. Capacity utilization in the manufacturing sector, according to RBI's latest survey, which we have published, is around 75%. But I am told that the CII's survey shows that capacity utilization in manufacturing sector is even higher. I don't know whether they have shared the number with you, so I'm not mentioning it, but in our interaction last week in Mumbai, I was told that, I have the number, and it is clearly much more than 75%. So capacity utilization in the manufacturing sector continues to be robust. Credit offtake in banks also is remaining quite resilient. It's about 15.5% credit growth according to the latest data. Over the last 1 year, we see credit offtake, the banking sector credit, I'm talking about bank credit. The growth is about 15.5 to 16%. The latest number I have is 15.5%. So therefore, these are the, these are the upsides to domestic growth, and that gives us the confidence that, India should be able to record a growth close to 6.5%. However, there are downside risks which are commonly, which is known to all of us. Geopolitical uncertainties, any surprises on the geopolitical front, and the drag from merchandise exports because world trade seems to be contracting. So these are the downside risks. And of course, on the agricultural front, there is this forecast of a El Nino, and we have to see whether it actually happens or how, if it happens, how intense it is. And there is talk by the IMD about the Indian Ocean Dipole. I am not an expert, but the IMD says that there is evidence of positive Indian Ocean Dipole, which to some extent should be able to neutralize the impact of El Nino. But let us leave that to weather experts. But this is an uncertainty which only time will tell to what extent it affects our economy. On top of this, all these factors which I mentioned, we have macroeconomic stability. Now, on the back of macroeconomic stability and the robust financial sector stability that we have, I think there is a platform for supporting domestic growth. Macroeconomic stability in the sense that inflation has moderated. The last print is 4.7. Perhaps the next print is could be lower. GDP growth, I have just mentioned, that is sustained. Current account deficit, which was earlier feared that it will touch 4%, 3.5%, we have given out the numbers. They look very much, and in the last year, it was eminently manageable, as I have said. We were helped by the fact that we are now witnessing record, remittances from abroad. The fiscal deficit, of course, of the government is also on a consolidation path. So on the back of macroeconomic stability and a robust financial sector, I will touch upon the financial sector a little later, but on the financial sector particularly, our banking sector today, the percentage of non-performing assets, according to the last December 2022 number we gave, the GNPA, that is gross non-performing assets of the banking sector at the systemic level, was 4.4%. We have the unaudited figures for the period ending March 23. They are even lower, but I would not like to mention the number because they are unaudited, and we would rather wait for the audited figures to come in. So the non-performing asset, which was a huge challenge for the Indian banking sector, has come down, has been moderated, and it is showing very good signs of its resilience. And on top of that, we have the advantage of demography, which again is a huge opportunity for India, and it's something, I think, which will eventually add to our potential output, or what some people prefer to call it as India's, growth potential. But let us call it potential output. So therefore, that's a thing which will play out in the medium to long term. There is one aspect which I must mention in a forum like this. It is with regard to access to technology and investment in technology. We are living in a highly fragmented world. Access to technology, availability of technology in a seamless manner has become a challenge. In this matter, the world is no more flat. Technology has become difficult to access. There are barriers, there are restrictions to get technology, and it's not flowing freely across boundaries. So therefore, while, I think it's for the industry also, apart from, the various other authorities, I think it's for the industry to play a primary role and to have access, to work out access to that technology. And what's even more important, I think as a country we need to invest more in technology, because the future belongs to technology, and unless we have technology, we will not be able to sustain our progress. But I am quite optimistic that this is an area where the public and the private authorities, the public and the private sector associations like the CII and the authorities in the government will be able to work together, and this challenge will be converted into an opportunity. But domestic investment in technology has to grow, and private sector has a big role in it. India demonstrated that in the context of COVID, when the vaccines were produced within the country, and a population of 1.4 billion was vaccinated in India, perhaps the highest vaccination that was done world over. And I think we have the capacity, we have the potential, but this is something which I would particularly in a forum through the CII, I would like to appeal to the members of CII to focus on this aspect, because this is something which India needs to sustain its growth. The third aspect I wish to talk about is with regard to inflation. Now, inflation has moderated, but there is no room for complacency. Let me just touch upon our, the inflation path that we went through, the challenges that we went through over the last 1 year. In February last year, the outlook was very benign. We assumed that inflation will come out. Inflation will sort of moderate. But then we had the big surprise from the Ukraine war. Nobody expected the Ukraine war to sort of really happen, and to sort of with such intensity. And naturally, it had impact on prices of food grains, on edible oil, on cereals, on across the board. The commodity prices shot up. The crude oil, which is again a primary, India being a huge importer of crude, all prices went up, and naturally India was impacted. Now, when the war came as a surprise, naturally, as a central bank, we cannot say that we will not give any surprises. I mean, we had to also, therefore, do a surprise meeting last year. Many of you, that time it looked, in fact, we faced quite a bit of criticism. But what the market missed out at that stage is that in April itself, we had given some early signals of our impending action. We had changed our priority to inflation over growth, And we had given some indications saying that the Reserve Bank is monitoring the situation closely and will not hesitate to act if the situation so warrants. So we took that surprise, we did that surprise meeting. One point which I want to mention here, nobody likes to give surprises, but when sometimes the situation itself gives you surprises and overtakes you, a situation like when the war happens, which was not expected by anyone, naturally, I mean, things are, different. So therefore, we had to have that surprise meeting of the MPC. I'm not trying to be defensive about it, because subsequent developments have proved that the decision of the Monetary Policy Committee to meet, to hold a surprise meeting and to start the cycle of rate increase was the right decision. And I think that has been now accepted and recognized all around. Again, last MPC, we gave you a positive surprise by taking a pause. I think the whole market was expecting that the Reserve Bank perhaps will take the Reserve Bank will perhaps increase by 25 basis points. But we gave a positive surprise because our assessment was that we have done 250 basis points rate increase. Let's now allow that impact to play out. Increase in rates, monetary policy acts with a time lag, and you have to allow that time for the monetary policy to play out and to transmit. We monitor the monetary policy transmission both in the credit side as well as both in the interest rate side so far as credit is concerned, the market interest rates are concerned, the overnight rates of money markets. So far as that is concerned, we also monitor the transmission in the liability side, namely in the deposit side. So therefore, the situation is extremely fluid, the situation is highly dynamic, and I would just like to say that the war on inflation is not over. We have to remain alert. There is no cause for complacency. Especially, we'll have to see how the El Nino factor, what has been anticipated, the El Nino, how it plays out. The third aspect which I would like to mention is with regard to, I think that is the fourth aspect which I would like to mention, is with regard to the policy approach of the Reserve Bank. Now, our endeavor, especially over the last 3 to 4 years, when we have been confronted, like the entire rest of the world, we have been confronted with huge uncertainties. We have been confronted with black swan events, one after the other. The COVID, followed by the war, followed by the synchronized monetary policy tightening, the fragmentation of global trade, the fragmentation of supply chain, and host of other challenges have the sudden increase of commodity prices. We have really, I think all central banks, all authorities, and business in particular also, we have all gone through fire. And in times like this, it's very heartening to note that the Indian business has responded with resilience. The Indian business, industry and business on the whole has utilized this opportunity, utilized this challenge to improve, to strengthen its inherent resilience. When we undertook many liquidity infusion measures, we saw a clear evidence of companies, big and small, deleveraging themselves, using the liquidity available in the market, using the benign liquidity conditions. Corporates deleveraged themselves and repaid their reduced their high-cost borrowings. So as a result, when the pandemic ended, I think most of the corporates, or should I say many of the corporates, had balance sheets which were which were deleveraged compared to where they started before the pandemic. So far as the Reserve Bank is concerned, our approach and our endeavor has always been to be prudent, proactive, and act in time. These have been the guiding principles. Prudent, it's our endeavor to be prudent, proactive, and to act in time. While remaining always alert, it has been our endeavor to sort of respond to the situation and also anticipate emerging situations and then respond to that. I would not like to elaborate on that at length, but just I wish to touch upon a few points. For example, when the COVID started in March 27, on 27th of March 2020, we again had a surprise meeting of the Monetary Policy Committee, and we announced a host of measures. We reduced the interest rates by 75 basis points. We announced more than 3 lakh crore of liquidity support, liquidity infusion into the market. When the Delta wave came that year, in May 2021, the May of 2021, we came out with again a package for the MSMEs just within 15 days of the onset of the Delta wave, because our expectation, our apprehension was that the Delta wave perhaps is going to cause a bigger damage. So we again came out with a restructuring, a resolution package for the MSMEs. We again provided special liquidity window for the contact-intensive services and also for the healthcare sector. On inflation also, as I have just mentioned, that we have always tried to take timely actions. Our effort has been to, I think looking back, I can say that we were prudent then when we decided to increase the rates by in a surprise meeting, and we are also prudent now when we have decided to take a pause. So it's a case of prudent then and prudent now. That's our assessment. I mean, somebody can disagree with that, but it gives us a lot of satisfaction that the markets, the industry, the business, and even the analysts have endorsed the decision of the Reserve Bank of India. On liquidity also, we have always remained proactive. We undertook, in a post-ILFS scenario in 2019, when the financial markets had dried up for liquidity, when the activity on the financial markets was getting frozen because there was no liquidity, we adopted innovative methods like the buy-sell swap of foreign exchange, and we did about 10 billion auctions, infused liquidity apart from other measures. We have undertaken variable rate reverse repo auctions. I am not going into, all these technicalities, but basically it has been our effort to remain always proactive. Last week we undertook, based on an analysis of the liquidity conditions, we undertook a variable rate repo auction to inject 50,000 crores to the market. Our analysis was that overall at the system level, there was surplus liquidity of about 1 lakh crore. But in certain banks and institutions, there was lack of liquidity. So we undertook this, reverse repo auction of 50,000 crores, and against which we got response for 47,000 crores. In a forum like CII, I would like to assure that the Reserve Bank will ensure that adequate liquidity is made available for meeting the productive requirements of the economy. We have also, been quite, we have attempted to be, and we have endeavored to also remain proactive so far as the foreign exchange management of the country is concerned. We utilized the situation of COVID, and also around that time when India witnessed a lot of FX inflows, we utilized the opportunity to build up reserves. And in fact, in a meeting in the IMF in 2019, I had openly stated that, because market intervention is often frowned upon by, many international institutions. And in IMF, I had said in an open forum that we are consciously building up buffers of foreign exchange, because when the cycle turns, when there is a crisis, when there are outflows, we have to only look after ourselves. So you cannot fault us for that. And I'm indeed very happy to note that the IMF has subsequently recognized that it is perfectly within the rights of, perfectly within the rights of emerging market economies to build up reserves, to manage their, to create capital buffers to deal with situations when there is foreign exchange outflow. So we took our foreign exchange reserves to the high. The peak was about $642 billion. Last year, after the COVID, after the Ukraine war started, there were surge of outflows, and we had to intervene in the market because our primary focus is to maintain stability of the Indian rupee, the stability of the exchange rate. Now, why stability is important? Because it gives that much confidence to the domestic investors, to the domestic business. It also gives that much confidence to international business, to international investors about the stability of the currency. Unless your currency, the exchange rate is stable, no investor, no business, no exporter, no importer will be able to do his business the way he wants. It has been our endeavor to maintain stability of the exchange rate. So therefore, we intervened in the market. And our reserves went down to about 524 billion. Of course, when it went down to 524 billion, it's not as if we were selling all the dollars. It was partly because we were intervening in the market by providing dollars, meeting the dollar shortage in the market. At the same time, there were what is called the valuation losses, because our foreign exchange is invested in many, securities of advanced, other countries. It is invested in gold. So when gold prices or the prices of the value of those securities go up or down, up or down, naturally there is a revaluation of our reserves. So it was partly valuation losses and partly our foreign exchange intervention in the market. The reserves came down to 524. There was criticism that the Reserve Bank is splurging. This was the word used by certain sections, that Reserve Bank is mindlessly splurging dollars. I had responded at that time by saying that we buy an umbrella to use it when it rains. We don't buy an umbrella to just store it as a decoration piece in our residence. And we were quite confident that the cycle will turn. And thankfully, we are also fortunate that the cycle has turned, and last Friday, the data we gave, the foreign exchange reserves were $599.5 billion US dollars. It's been fluctuating in the, between the 500, it's fluctuating around that. Sometimes it goes down by $4-5 billion, sometimes it goes up. That's primarily because of valuation gains or valuation losses. But we we monitor the market very closely to ensure that there is no excessive volatility of the exchange rate, to ensure that the exchange rate remains stable, and to anchor market expectations about the exchange rate. Our endeavor is always to have strong buffers so that India does not face the situation which we faced in 2013, that we as a country cannot afford to face. So that is always our endeavor. We have also taken steps with regard to, as you know, maybe I will leave it for subsequent interaction, with regard to, widening the footprint of the Indian rupee by announcing, what is called the international trade settlement in rupees. Number of steps have been taken, and so far 18 countries have, we have permitted 18 countries to have this rupee trade, a settlement of trade in rupees. 18 countries, 17 banks, and 65 special rupee Vostro accounts have been opened. Let me conclude as the last part by talking about financial stability. You see, the financial stability of every economy is very important for its progress, for its sustenance. What the Reserve Bank can do for supporting the country's growth story is that the Reserve Bank, as the major financial sector regulator, is committed to providing financial stability. We have taken steps to strengthen the regulation and supervision of the banking sector, the regulation and supervision of the NBFC sectors. We have come out with new regulatory framework for NBFCs. We have come out with new regulatory framework for urban cooperative banks, which form an important segment of our banking sector. We have come out with guidelines for digital lending. In fact, digital lending, last year when we came out with the guidelines, initially there were reservations expressed because it was that time perceived by some that Reserve Bank is perhaps unnecessarily interfering into fintech, a growing area, and action of Reserve Bank may stifle the growth of the fintech sector. But our approach was to provide a regulatory architecture under which the fintech sector grows and grows in a robust manner. 1 year down the line, I am very happy to share with you that our interaction with the fintech companies and the digital lending companies, they tell us that they are happy that the regulation has come, the regulatory framework of RBI has come, because the markets, their clientele and their investors, both domestic and international investors, now have greater trust and confidence on them, due to the fact that it is regulated by the central bank, and that gives them greater amount of confidence. Many of them have told us now it has become far easier for them to attract investment into their companies. So these are the areas where, we have tried to be always proactive, we have tried to act in time, and we have always tried to be prudent. Prudence for a central bank has to be the underlying theme, because we have to ensure long-term financial stability of the system. We play T20 cricket, we play one-day cricket, we also play test cricket, and the test cricket is, so far as the central bank is concerned, is never ending. Let me conclude by saying that today in India, we witness a confluence of factors which are feeding into the Indian growth story. The RBI will remain proactive, alert, and prudent, and do its best to support the economy, to maintain financial stability of India. Our endeavor is always to remain prudent. We were prudent then, we are prudent now, and we will continue to remain prudent and proactive in our actions to ensure financial stability. Thank you very much.
Thank you, Governor, for that very well-rounded discourse on the economy and the broader role that RBI has played in the last few years and the role that it plays. Governors kindly agreed to take a few questions. So let me start with the first one. And Governor, this is from my own sector, that's financial services, because after tomorrow, I go back to my job that pays me my salary. My question is that if we look a little longer into the future, we all over here agree that India has tremendous opportunity to build its economy towards that of a developed country. In this, what would be your own advice to how we can build a robust domestic financial services sector to support the real economy in that growth in the coming, say, decade?
You see, we have been taking a number of measures. The regulatory measures I don't want to again list out, but one thing which I would like to mention, and I have talked about it elsewhere also, is that we have significantly deepened our supervision of the financial sector, whether banks, whether NBFCs, and whether the cooperative banks or the various digital lending activities. Our supervision today has become much deeper. We are now undertaking unconventional and innovative things like, for example, for the first time we held a meeting of the public sector bank directors. There were 116 of them. All public sector bank, directors, all directors of all the 11 public sector banks were present. We had a day-long conference with them. We are going to have a similar conference with the directors, that is the members of the board of the private sector banks, about 200 more than 200 of them in Mumbai next week. So our focus has been to sort of ensure that the financial system, the financial sector remains stable. Now there are new areas which keep coming. For example, fintech and digital lending is something which we are actively now supporting. We are also doing things like, for example, with regard to digital lending now, with the help of our RBI Innovation Hub, we are now running pilot projects for, end-to-end digitized KCC, that is Kisan Credit Card loans to small farmers. The pilot is already in operation in the states of Madhya Pradesh and Tamil Nadu. We are going to start similar pilots in other states. And these are the kind of innovative products that which we are launching. We have launched the pilot in the central bank digital currencies, and there are many learnings from that experience, and based on that we are fine-tuning our CBDC architecture. In fact, the chief of the Bank of International Settlements, he was here for the G20 meetings in G20 meetings of the finance ministers and central bank governors earlier this year in February, I think it was. It was in February, isn't it? Yeah, it was in February. So there we were showcasing our CBDC, the central bank digital currency, that is the e-rupee. So he saw this and he has said it on record on media that it's excellent product. It has been designed very well, but the only thing he said he was missing was the smell of a new currency note. So CBDC, e-rupee is something which we have introduced. Digital payments we are supporting in a great way. I'm very happy to share with you the number, the total number of digital transactions, which were about 2.28 crores per day. Yes, 2.28 crore digital transactions per day was the situation in 2016. The latest data which I have with me is that it is 37.75 crore transactions per day. 37.75, you can say that about 38 crore transactions per day is the digital transactions. And within that, UPI, which was launched in 2016, has records a daily transaction of nearly 29.5 crores. It's a daily transaction. So we are trying to extend support in every measure, but I think, it's a question of, I mentioned about a confluence of factors. Each supports the other. So, government policies, capex, financial stability by the central bank, industry has to show greater confidence. I mean, you are the best judge. I am no one to advise you about your investment plans. But I think, given the confluence of factors that we have in India, I have confidence that Indian industry will respond and rise to the occasion and support Indian growth story and will play its role as a major stakeholder.
Thank you for that. Let me now request CB to take the discussion forward.
Thanks. Governor, just a few questions from the floor, and from, in the interest of time, we'll take 2-3 questions at one time, one go, and we'll try and take two tranches or so. Yeah.
Go ahead.
Yeah. So first, I'll request Dinesh and then the Vice President Sanjeev Puri to ask a question. But you spoke about internationalization of the rupee, and what do you see as the risk factors in that, and what is the type of mitigation that you are really working on in terms of the risks that you are seeing when you talk about internationalization of the Indian rupee? So I'll put that and maybe turn to Dinesh.
So to add my question, considering the overall return expectation scenario, how do we look at the regulations from a overseas funding for the growth which is required, as well as the domestic funding? I think we spoke about corporate growth. And if you look at both from an infrastructure side and from the capex for the future, how do you see regulations being more innovative or being more supportive for both domestic capex and overseas funding coming in there?
Governor, first, may I also congratulate you for the very pragmatic and timely interventions in this very complex and dynamic situation that's added to the resilience of the economy. And you have very rightly articulated the risks. And I want to just focus on one very important, which is structural, which is the climate emergency. And there is a whole, it's a, you know, the transition is a challenge for India because there is not only growth, there is also transition. And added to that is also adaptation, because temperatures are not going to suddenly fall. It will take, you know, several decades by the time it falls. And in that context, green finance assumes great importance. So what are your, it would be good to hear your perspectives on the possible pathways, both from domestic mobilization, banking and other channels, as well as external mobilization. Green finance.
Thank you. First, addressing Chandrajit's question. You see, internationalization of the rupee is a process. It's not a target. You know, it's a process, and we are working towards that. It's directly linked to the volume of our world trade. You know, it's the volume of our imports and exports together. Our share of world trade, what is the size, what is the magnitude of our, you know, what is the size of India's, what is India's share of the world trade? That is a very relevant factor. And here, as you know, India's export numbers are really rising very fast. And despite some moderation in the merchandise exports, services sectors have done better than anticipated. So therefore, our export sector is very important. It is growing, and it needs to grow even more. And I think government has announced a very optimistic, not optimistic, a very strong target for the current year, and there is no reason why it cannot be achieved. Last year's number was achieved. This year's number, I'm quite confident that they will achieve it. So India's share in global trade has to rise. Now, the difficulties and the risks which you are pointing it out, it first depends on individual exporters and importers, because ultimately somebody is importing, somebody is exporting. So they have to first evaluate their, risks. So far as the central bank, the Reserve Bank is concerned, we analyze each country. You know, there is a specific analysis, country by country we make analysis, and then the permissions are given to undertake this rupee settlement of international trade. Now, there are countries which have trade surplus with us. And when they hold excess rupee in their Vostro accounts in India, what does he do with his surplus rupees? So we have said that that can be invested in India, in the GSEC, in the T-bills, in other investment, in other investment avenues. The surplus rupee which they are holding, that can be invested here. There are also countries which have trade deficit with India. So they may have a shortage of rupees. So how do you address that issue? So that also is now under examination. We are examining various options, and we will deal with it. So on a country-by-country basis, we analyze, we evaluate the risks. Obviously, this is done with great amount of consultation between the RBI and the government. There has to be consultation between the government and the RBI on these matters. And that is how we are moving, as I said. We weigh all the risk factors, and then we move forward. Now, with regard to the foreign, investment, whether FPI or FDI, as you know, the FDI regime is now almost completely liberalized. So far as FPI is concerned, we have set certain prudential limits for FPI inflows, but the actual inflows are lower than that. And in the month of May alone, contrary to the picture that prevailed, I think in the month of May alone, I don't have the numbers right away, but in the month of May alone, the FPI inflows have shown again a positive trend. They have shown an uptake. It is ultimately the confidence of the foreign investor in Indian markets. If you look around today, where will the international investment go? There are few opportunities available. Emerging market economies are definitely an attraction. And within that, I think India is definitely on the top. So we this year expect the inflows, the FX inflows, to be maintained, to be sustained. But naturally, we would be, it's always desirable that you have more, you have more durable kind of liquidity, durable kind of FX inflows, investments which come in the form of FDI or with long-term stake. That is always good. But I think Indian economy has now reached a size and strength where, even the short-term flows this way or that way are, are quite manageable. But ultimately, it's a question of the confidence of international investors. If we continue to provide, and we are providing, if we continue to provide macroeconomic stability, financial sector stability, exchange rate stability, I think this would be a confluence of factors which would attract foreign investments. And coming to the climate issue, we came out with a discussion paper on climate change, and this is on top of the G20 discussions. In fact, central banks are also increasingly turning their attention to the climate issues. There are central banks even today which take the view that it's for the government to really do, to focus on the issues of climate change. But we are of the view that central banks have a role. We are not trying to do what the government alone can do. I mean, that's not our area. But talking about climate change, talking about green finance, the central banks will have to ensure that there is proper taxonomy, that there is avoidance of what is called greenwashing. And precisely because of this objective, we have laid down the guidelines for green deposits. In fact, somebody asked me, what is the purpose of green deposits? I mean, after all, people are putting money in banks. They will continue to put money in their deposits. What is the, how is it relevant or important to have a separate guideline for green deposit? Now, that is because when you have a central bank defined framework for green deposits, the investors who are interested in supporting green finance, they will feel confident. It will give them that much confidence to put their money on those instruments. It also will prevent greenwashing. It will also assist the process of a proper taxonomy with regard to, what is green finance and what is not. And also there are issues like when the lenders do financing for any, any project, what are the climate risks of those projects going forward, whether that business will survive beyond 10 years or it is for the next 5 years. What are the climate related challenges which a business has? That also every lender, whether it is a bank or a non-bank finance company, every lender has to make his assessment as a part of his appraisal. He has to factor in the medium and the long-term impact of climate change on projects or activities which he is financing.
Thank you. Though we are a little overshot on time, if we can take one round from the... So we have three requests from the floor. One, Dr. Naushad Forbes, second, Vinayak Chatterjee, Janmajaya Sinha, and Mr. Jamshid Godrej. So in that order, we'll go. Naushad.
Governor, thank you very much. Thank you first for your very steady and responsive leadership. We especially appreciate it when the world around us is so uncertain. In the same area of uncertainty, sometimes I worry that there is a need to do things and fix small issues. And in that light, perhaps sometimes an alternative is to do nothing. So for example, if you take the 2,000 rupee note removal from the economy, circulation had come down quite substantially. It had dropped to about a third, I think, of what it was in 2017 in an automatic way as the RBI had stopped printing notes. So did one consider the alternative of simply letting that decline continue to happen in a natural way as opposed to saying, look, let's withdraw it from circulation. And second, also with the LRS limits. You know, the LRS has been a very positive development for us as an economy and us as individuals who travel a lot overseas. And I wonder whether one could simply, you know, sometimes these are issues that need to be fixed, but the doing nothing alternative sometimes only fosters greater certainty, fosters greater confidence that one doesn't need to deal on a personal level with some of these things that come along and suddenly you have one more thing to worry about.
Vinayak?
Governor, Vinayak Chatterjee here. Good afternoon, and a pleasure to be having this occasion to interact with you. I have a specific question from the infrastructure sector. 2 years ago, the finance minister announced in her budget speech about the launch of a new product called surety bonds. They were supposed to be a major source of replacement for the traditional bank guarantees, which over the years have become a very major choke point for the infrastructure sectors, both developers and EPC contractors. Now 2 years have gone by, and we haven't seen much traction in this product that was much anticipated called the surety bonds. And the belief is that it has fallen in the cracks between two regulators, RBI and IRDI, the Insurance Regulatory Development Authority. The request is, could you get people in RBI to take a hard look as to what is constraining surety bonds as emerging in the market to help the infrastructure sector as a very, very major replacement for bank guarantees? Thank you.
Janmay?
Good morning, Governor. I have a question which builds on what the finance